Thank you for joining us. The following presentation is from a webinar titled Mission Critical, a practical update of nonprofit accounting, tax, and governance hot topics, originally produced on July 2nd, 2013. The presenter is Jim Shellenberger with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for future events and webinars.
All right, thank you, Reid. I'm excited to be here for our Mission Critical, a practical update of nonprofit accounting, tax, and governance hot topics. This is something that is of passion of mine. I am very, very familiar with the not-for-profit industry and a servant of the industry, and I'm glad to be here to talk to you about it. Before I get started, I want to talk a little bit about myself and introduce you to me. My name is Jim Shellenberger, again, Senior Manager with McKonly Asbury's Audit Group. I've been working with McKonly Asbury, wow, I can't believe, almost 11 and a half years now. And since that time, I started in the not-for-profit industry, as well as a couple other industries that I work in here in the firm. But the not-for-profit industry is one that has become, like I said, a passion of mine, and something that is a passion not only on a professional level, but also on a personal level. I'm an avid not-for-profit volunteer. I serve on a number of not-for-profit boards in the local central Pennsylvania area, and also serve on the statewide PICPA not-for-profit committee. That is the Pennsylvania Institute of Certified Public Accountants, and the group that helps set the standards from a state perspective regarding technical issues and responding to FASB updates, AICPA updates, and developing the training that ultimately the not-for-profit leaders in our state follow. So again, I'm glad to be here and excited for this presentation. A little bit about McKonly Asbury. We're a regional accounting firm headquartered in Harrisburg, and we also have a strong presence in Lancaster. 2013, McKonly Asbury is celebrating our 40th year, as you can see from the theme of our slides throughout today's presentation. And one of our core industries in areas that we serve the community is the not-for-profit community. And we do that in audit and tax, and also on a consulting basis. And one of the things that I think makes McKonly Asbury unique in the not-for-profit world is that we really encourage our employees to serve on not-for-profit boards and volunteer. I mentioned it earlier on my slide previously that I'm a not-for-profit board member and also a volunteer. And I can comfortably say that probably 80 to 85% of the employees here at McKonly Asbury are in the same category as me with that respect. So it's an area of focus for our firm and something that we're proud to serve. Okay, the topics that we're going to cover today are in four main areas. We're going to do a very brief accounting standards update where we'll cover two of the most recently issued ASUs that are effective for the not-for-profit community. After that, we'll talk a little bit about single audit guidance and some proposed changes that the OMB has issued over the last couple months and what that would mean to the single audit community. And then we'll really get into the meat of my presentation, which focuses on 5 policies that all not-for-profits should have in place, and also Jim's top 10 hot topics in the not-for-profit world, things that will help from a governance standpoint make you and your organization better. So why do this webinar? Well, I think the obvious reason a lot of people are here, other than that you're really passionate about nonprofits like me, at least I hope you are, is to get some CPE credit. Today, this is a reporting year for Pennsylvania, so I know a lot of people out there are looking to get credit. But there are a lot of other real reasons why we're doing this webinar. The not-for-profits are entering what's called their busy season. Many nonprofit organizations have June 30th as their year end, so we just got past that over the weekend, and now we're into our year-end close, and there's a lot of things that we're thinking about as auditors here, because we're really ramping up to get into some of the organizations that we work with. Nonprofits are a huge part of the United States economy and really the economy of Pennsylvania. You know, I pulled some stats from a recent conference I was at about a month ago that the PICPA put on, and I want to share these with you. And I was astounded when I saw these numbers. There's 72,000 nonprofit organizations in the state of Pennsylvania. That's unbelievable to me. That's 72,000 nonprofit organizations. Of those organizations, 55,000 of them file a IRS Form 990. The IRS Form 990 is the information return that it's required to be filed on an annual basis for nonprofit organizations over a certain threshold. Between the 72 and the 55, it means there's a lot of small nonprofits who can file what's called a postcard filing or possibly a 990 easy filing. But that's 55,000 large nonprofit organizations. 52,000 of those are public charities. 4,500 of them are foundations. some astronomical numbers. From a dollar standpoint, those organizations contribute $112.6 billion to the Pennsylvania economy. Again, some pretty fascinating numbers. 634,000 employees in Pennsylvania are employed by nonprofit organizations. So it's very easy to see that nonprofits do play a huge part of our economy and are very important. Again, I think that's why we're all here today. Accounting rules are not getting any easier, guys. They're constantly changing. There's a lot of stuff on the horizon, and I want to do my best to make sure that the community is updated regarding those standards. Now, there's not a lot of new standards that are effective this year, and I think I mentioned that earlier, but there are a couple things on the horizon and a few small changes that I want to highlight. And finally, in regards to those tips I was talking about, governance is so important. Governance is a tool that you can use to fight fraud, abuse, bad press. It's very common to see in the newspapers these days regarding nonprofit organizations and their hiccups and mess ups, and the press loves to jump on these kinds of stories. And there's some very easy things that you can do as an organization leader to help fight this. And hopefully some of these tips and recommendations I have for you today can go a little bit towards helping that cause. Okay, I have our standard disclaimer slide here, and what I'm saying here on this slide, and I just want the message to be clear that I am not an authoritative standard setter body. The opinions that I'm presenting in this are of my own. I consider myself very well versed in nonprofit accounting, auditing, technical guidance, and also governance tools. But again, I am not the FASB. I'm not the AICPA. I'm not the state society. So I'm not the federal government. So I just want to have that disclaimer out there, and certainly please consult your accountants and your advisors as appropriate. So we're going to start with our accounting standards update today, and we're going to move right into a recent accounting standard update that was issued in draft form last year, and that is called the Classification of Sale Proceeds from Donated Securities. ASU 2012-5 was issued in October 2012, and some of you on this webinar, I can see from the people who have logged in already, were some of the attendees at my nonprofit seminar that I had back in spring of 2012, where I talked about the exposure draft that was issued in April 2012. This ASU, while important, isn't a huge change to the way that many nonprofits account for donated securities. When I say donated securities, this is things that come in on an infrequent basis. Perhaps your nonprofit organization was named in an estate or trust, and because of that, you're receiving securities, or you have a wealthy benefactor who has provided a couple shares of a stock to the organization. There's been some inconsistent treatment in how the classification of the proceeds from these assets are reported on just the statement of cash flows. And in the past, they were often reported as an investing activity similar to any other investment of securities that the nonprofit organization might have already had. So what the FASB concluded was that the proceeds that are a result of donated securities, donated financial assets, are really the same as operating activity or a general contribution. And because of this, it should be accounted for in the operating section of the statement of cash flows. And when you step back and you think about this, this makes a lot of sense. Nonprofit organizations typically have a policy that requires immediate conversion of a donated financial asset, a security, to cash. So you might get notification that you are the lucky recipient of 100 shares of Apple stock. And even though you want to hold on to that Apple stock and see it climb and climb and climb, hopefully, rebound some of the losses that have occurred over the last couple of months, you have a policy that you're going to send that over to your investment broker, and they're going to immediately convert it to cash, and you're going to take those proceeds and put them into your bank account. That's the conservative policy that a lot of nonprofit organizations have, and that they should, honestly, that they should have. There's no difference in that transaction being a general contribution of money than it is shares, and because of that, it should be classified as an operating activity. That being said, if I donate those shares of Apple stock and I say you need to hold on to the proceeds from those shares of Apple stock and use them to purchase iPads for everybody in your daycare program, that money is now considered restricted, and because of that, it's considered a financing activity, and that those proceeds should be classified not as an operating activity, but because of a financing activity, and that has to do with the donor restriction that was placed along with those assets. As I mentioned, most organizations already have a conversion policy. So if you don't have one, I'm going to encourage you to create one, and that's something that your accountant, your advisor can certainly help you out with. But essentially what it means is that upon the receipt and notification of donated assets, that those assets are immediately converted to cash and that you have the ability to do so, and that policy will dictate that for you. This standard update is effective for fiscal years beginning after 6/15/2013. Early adoption is permitted, and on the clients and nonprofit organizations that I'm working with, I'm already advising them to go ahead and early adopt this because it is, again, a very easy standard to implement. Okay, the next accounting standard that I want to talk about is ASU 2013-6, which was issued back in April of 2013, not that long ago. And that has to relate to services that were received from personnel of an affiliate. Nonprofit organizations are required to recognize in-kind services for people who donate certain specified time. We think about all the things that nonprofit organizations look to have contributed to them. Time is a big thing, and oftentimes that comes from personnel of an affiliate. The goal of this ASU is to increase the transparency of transactions and reduce diversity in practice. And what that means is that certain nonprofit organizations had a policy and practice for recognizing these types of services from an affiliate, and others were not. And again, the ASU is seeking to see consistency in standards for recognizing these types of services. Under the old guidance, services that were received from an affiliate were only recognized at fair value if services are regularly performed, and the services either A, create or enhance non-financial assets, or B, require specialized skills. And those two caveats, that A and B I just spoke about, are those same criteria that are applied to any type of other donated services that you might receive from a lawyer or an accountant or an engineer if you're doing a building acquisition. So services from an affiliate were only recognized if they met that criteria and were also regularly performed. Because of that, that regularly performed caveat, they weren't always recognized. And this ASU is seeking to kind of get rid of that and apply the characteristics that any other type of recognition would involve. The ASU states that they should be measured at actual costs incurred by the affiliate. So if you're receiving donated services from affiliate, perhaps it's management services, perhaps it's accounting services, whatever cost that affiliate is incurring to have those services performed is the amount that should be recognized on your organization's financial statements. So it should be measured at cost. However, there is a fair value election that could be made in certain circumstances, and I'll talk about that in a second. This standard is effective for fiscal years beginning after 6/15/2014, so we have a little bit of time to pull it in, even though that it's not very sweeping of a change to a lot of organizations. I think it will come into play more in the healthcare arena, where you have a lot of affiliated entities. Those standalone not-for-profit organizations who don't have a lot of affiliates are probably not going to have a big impact because of this. I mentioned earlier that there is a fair value exception. You have to, from a practical standpoint, look at the cost that's being incurred by an affiliate. And if it significantly overstates or understates the value of the service that was provided, the fair value assumption can be used to record that on your organization's financial statements. Again, this is effective for years beginning after 6/15/2014. So that, again, we have some time. Early adoption is permitted. I don't see this as a wide sweeping change in certain industries. I think some of the nonprofit organizations, the larger, more sophisticated ones, are going to have some things to consider when they have affiliates. But those standalone organizations that don't have a lot of affiliates are not going to see a lot of changes because of this. Okay, that concludes the update on the two most recent ASUs that were issued relative to the not-for-profit community. Before I move into the updated changes to the OMB single audit guidance, I want to take just a few minutes to talk about the clarified auditing standards. Now, these are not accounting standards that were issued, but were actually auditing clarifications that are going to be impacting many not-for-profit audits here, effective really this week for those that are June 30th year ends. The clarified auditing standards were effective for periods ending after December 15th. 15th, 2012. So like I just said, most nonprofits will see these in their most recent upcoming audit. And really the goal of the clarified auditing standards was to increase the communication between auditors and the clients and do a better job at explaining auditors' requirements and objectives in performing the audit, but also management's responsibility for financial statements, and really moving towards convergence with international standards on auditing. The biggest impact that I think nonprofits will see is in the standard independent auditors report. If you were to hold up last year's auditors report to the current year auditors report, you'll see that the format of it is different, but essentially says the same thing. In addition, you will most likely see additional communication from your auditors during this most upcoming audit engagement, and that is because of the low threshold that auditors have to communicate things to management. We will continue to have to be required to communicate in written form material weaknesses and significant deficiencies, but also we're now required to communicate anything that we deem of sufficient importance to management's attention during the audit. So this is a very low threshold and something that the auditors will be focusing on for your upcoming engagements. All right, so we're going to move now into some proposed single audit changes. And single audit, again, is an audit of compliance. It's required for organizations that receive federal dollars. So back in January of 2013, the Office of Management Budget, or the OMB as we refer to it very commonly in the profession, issued some proposed changes. And this is something that, similar to lease accounting, has been on the horizon and we've been looking forward to. And these changes were designed to streamline the audit process for the federal government. I think they're looking for every possible way to continue to administer and manage the $600 billion in grants that are dispersed on a federal level every year, continue to manage and report on them, but make it in a more streamlined and efficient manner, and hopefully eliminate some of the work that is duplicated, whether it's by an accounting firm, auditors, or their own federal auditors. So this guidance is seeking to make things a little bit clearer, and hopefully that is the case. So the key change, and I think the thing that jumps out initially when somebody looks at the proposed changes, and this is, again, it's available on the OMB website if you want to look at all the key changes. And I think that document is a couple hundred pages long, but the thing that jumps out initially when you look at this is that the audit requirement is raised from $500,000 to $750,000. And this is a big change because there's a lot of organizations in our local community here in central Pennsylvania that receive just over $500,000 in federal funds, whether it's passed through from a state agency or direct recipient. So I think that will help alleviate some audit requirements that these organizations were held to that were essentially the same as organizations who were receiving millions upon millions of dollars of federal dollars. Now this threshold is being raised. I think it's been thrown out there that this number could have been $1 million. It could have been maybe a little bit higher, but I think $750,000 is a good start. Personally, I'd like to see it a little bit higher, but I can live with this change, if you will. Now, in the proposed guidance, if you do receive less than $750,000, doesn't mean that you don't have any type of reporting requirement. You still have to have all your information together and available to review if asked by any type of pass-through entity, the government accounting office, the federal government, or any type of state or federal agency. To put that into perspective, and these are some data from 2010, which is one of the last years of full data that I was able to compile. The total number of audits in 2010, single audits that were performed for entities with more than $750,000 of federal funds, was 38,704 entities had audits. Those organizations that had audits that were less than $750,000 in federal funds, there's 6,000 entities. So what that means is, under the new guidance, 6,000 organizations who had to go through an audit no longer would have to do that. That sounds like a lot. You look at the percentages that are on this slide, 86% to 14%. But when you look at the total federal dollars that are being impacted by this, it's less than 1%. There's so many large entities out there who are receiving large amounts of federal dollars that they're not going to be affected by this. But on the top end. But on the bottom end, you're going to see approximately 6,000 organizations fall off the single audit threshold. But that's still not going to impact the total federal dollars that are subject to audit. So it's going to allow those small nonprofit organizations who had to go through this requirement to be alleviated from that burden. Another key change that it's in the new proposed single audit guidance is that the threshold to determine a Type A and Type B program, and I could do a whole webinar on major program determination and single audit testing to talk about Type A and Type B programs, but that threshold is being revised and raised from $300,000 to $500,000. Back when the guidance was previously amended, the threshold that we had just gone through, that raised to $750,000, was raised to $500,000, and at that time the A/B threshold was not raised. So this is kind of a catch-up change in my mind. There'll be some changes to the high-risk Type A program criteria to determine whether Type A programs are high risk. Some of those changes regard whether or not there's been findings in the prior year. The auditor's report on the overall financial statements in the prior years as well is one of these components. And as I've reviewed these, I think it makes the process a little more straightforward for Type A program high risk determination. And conversely, they've simplified the process for identifying Type B programs. And I think that will help auditors go through the process of determining which programs ultimately be tested, and it should make it a little bit clearer to those organizations who are being audited which programs are of high and low risk. Another huge key change is a reduction in the number of compliance requirements. Single audits currently, there's 14 different compliance requirements that auditors have to look at. The new guidance has taken that number and dropped it from 14 to 6, and those are listed here on the slide for you to take a look at. On the surface, this looks great to anybody. I think they would love to see less testing, because there's a lot of compliance requirements that either were not applicable or required duplicate or redundant testing. The one thing that is included in the guidance is under the special test and provision categories that the OMB and the agency who's releasing funds for disbursement has this special test and provision category, which can ultimately include a lot. And it's been suggested that the special test and provisions compliance requirement will include more testing than was in the previous guidance. So even though the number might have dropped from 14 to 6, I think the level of testing will probably be the same because of the special test and provisions category that will have probably some new requirements. And in addition, some of the testing sample sizes might be larger for those other 5 requirements that are being tested under the new proposed guidance. A couple other key changes that were included in the guidance that was issued back in January is that the percentage of coverage rule was reduced. Again, I think this is a very positive change to the guidance. In the past, under a normal single audit, that the auditee did not meet certain low-risk criteria, 50% of the federal funds had to be subject to audit, and 25% if that auditee had qualified for low-risk status. That's being reduced to 40% and 20%. So again, it should hopefully reduce some of the testing that is being required. I mentioned low-risk auditee status. They've tweaked the criteria for determining whether or not your entity will qualify as a low-risk auditee, and that's included in the new guidance. I think similar to financial statements where authoritative bodies are asking for more information, the OMB is going to be asking for more information regarding to auditor findings. So if you're under the unfortunate circumstance to have an audit finding as a result of a single audit, there's more requirements to disclose more information regarding that finding. However, they've raised the threshold for reporting question costs from $10,000 to $25,000. So and I think it's kind of a give and take relationship there. They're raising the threshold to report question costs pretty significantly, but if you do have question costs in the finding, you're going to be required to present a lot more information regarding that issue. And then kind of on the back end, they're going to combine 8 existing other circulars into one comprehensive document. I think that's something that will help anybody who's working through a single audit to have one document to go through for all their guidance and supporting information needed to complete the audit. Now, this being said, all these proposed changes, I don't foresee this becoming effective again anytime soon. As we've all seen in the news over the last couple of years, or last couple of weeks and months, there's been some key shakeups at the IRS and other federal agencies, including the OMB. We're not currently in an election year, so I don't think this is going to play into any type of election decisions that are going to be made on the federal government level. It's anybody's best guess when these things will be made effective, but I don't foresee it being anytime soon. I think we're a couple years away from this taking shape. Okay, now that we've gotten through what I like to update you on some of the guidance that's out there, I want to move into the next part of my presentation, the second half of the presentation, that's regarding more towards governance and making your organizations better. And I want to start by going over five policies that I think every not-for-profit organization should have in place, and a little bit about those policies and how they can make you and your organization a little bit stronger and better. So the first policy document that I want to talk about is the Code of Conduct. I like to think of the Code of Conduct more of a code of ethics, if you will. Ethics is a buzzword that's out there in the world right now, and it gets a lot of attention, and I think it's a very important word. And a code of conduct, code of ethics, is something that really answers the question for an organization, what's right and what's wrong, and defines an organization's values. Thinking about my own organization, McKonly Asbury, our core values are collaboration, integrity, and stewardship. And that really defines who we are as an organization. You know, our purpose, our code of conduct, we take from our core values is to develop our colleagues, we serve our clients, and enhance our communities. And that's something that it's actually on the wall right here in the room that I'm in right now that I'm looking at. That it's everywhere that we are, and it really defines who we are. So nonprofit organizations should take the step to develop their code of conduct, code of ethics, and really expand on those core values and make it a living document. It should be written. It should be there for everybody to look at, and you should be proud of it. I carry a business card around in my wallet that has these core values and our code of ethic on them. At board meetings that I attend as a volunteer, oftentimes we'll read our code of conduct and discuss our core values and make sure that everybody is on board regarding those, that they understand them. It's part of our new employee training program. When a new employee starts at McKonly Asbury, it's something that we talk about within the first hour, that they understand and can ultimately respect our code of conduct. Like I said, make it a living document. Ultimately, it defines who you are as an organization and is of very, very significant importance to your mission. You should be proud of it. It should be part of who you are and define who you are. The second policy document that I want to talk about is more of a policy, if you will. It's the code of the conflict of interest policy. A conflict of interest policy is something that the IRS 990 has required since it was revamped a couple years ago, and actually asked for this specifically. And really, a conflict of interest policy gets down to requiring periodic disclosure of potential conflicts of interest. That's what the whole purpose of the policy is to identify potential conflicts. Start with board members. I think that's the best place to start developing a conflict of interest policy, but it needs to ultimately be pushed down to employees. There's nothing wrong with having a conflict of interest policy for all employees. In fact, again, something we do at McKonly Asbury. That's part of who we are on an annual basis. We look for potential conflicts of interest. Now, we have to do that as CPAs, but it's good practice for any nonprofit organization. I think in developing conflict of interest policies, it's best to think of examples of conflicts of interest. So a few examples of conflict of interest, I think some of these are pretty obvious. is when you have a relative or close friend reports to a supervisor who affects their responsibilities, their pay, their promotion. That's an obvious conflict of interest. Board members who have ownership in a business that does business with a nonprofit organization, that's a conflict of interest that needs to be disclosed. Not to say it can't occur, but there needs to be certain disclosures made about that. It needs to not be secretive and hidden, but it needs to be out there for everybody to understand and to know. Accepting gifts from vendors, conflict of interest. And employees that engage in activities outside of an organization that distract from their ability to perform their assigned role. That's kind of a broad category, but those are examples of conflicts of interest that can be thought of as you're developing this policy. The IRS, on their IRS Form 990, ask about conflict of interest, and they refer not only to board of directors, but they use the term officers, directors, trustees, and key employees. So I mentioned earlier that this needs to be pushed down to employees as well, and it should be. And lastly, there should be some type of monitoring built into this policy that somebody's reviewing potential conflicts of interest and determining ultimately what the resolution to that potential conflict will be and how the organization will address it. The third policy document that I want to talk about is the Whistleblower Policy. Again, this is one of those policies and buzzwords that's been out there for a number of years since the days of Sarbanes-Oxley. But why you want to have a whistleblower policy? You want to allow everyone that's associated with an organization the ability to come forward without fear of retaliation. If there is a fraud or something going on in an organization, you want that to be able to be reported as a board member, as a chief financial officer, as an executive director of a nonprofit. You don't want your employees and volunteers concerned with the ability to report a potential problem. Whistleblower policy should be written. I've seen many organizations that I've worked with who say they have a whistleblower policy, and they talk about their employees know that they can come and talk with senior management or board members regarding conflicts, but it's not written. You don't want to assume that all employees know what to do. You want to have it written down so they know exactly what type of procedure to follow. A good policy will have safeguards built into the policy, such as zero tolerance for harassment of somebody who reports a potential problem. Your policy should have confidentiality built into it. It should have a mechanism for anonymous allegations. Some people might not be comfortable reporting a suspected fraud or misappropriation because of fear of that retaliation. There should be a mechanism built in regarding anonymous allegations. Likewise, there should be repercussions for bad faith allegations. That if you clearly are just trying to get underneath somebody's skin and you're making some allegations with no basis, there should be some repercussions for bad faith allegations. Response is very important within a whistleblower policy. There should be some type of a calculated and followed procedure regarding response. Some of the things that I've seen implemented for nonprofit organizations is the institution of a hotline. There's a lot of organizations out there who provide this services to nonprofits and for-profit companies as well. Or they can have a committee or designated chief employee responsible for providing that response to any type of whistleblower items. As I mentioned earlier, this is a question that's on your IRS Form 990 and needs to be answered appropriately, and the government's looking for this information. So, again, a very important policy and one that I think benefits those who it applies to. The fourth policy or document I want to talk about is the Policies and Procedures Manual. A policy and procedures manual is so critical to a nonprofit organization because oftentimes within an organization there's a lot of turnover and transition in some positions where key transactions occur. And this manual, this policy and procedure manual, should document significant operational and accounting processes, because you never know when somebody might leave or when unexpected circumstances might arise where you need to jump in or have a new employee jump in to get something done. Processes that should be documented in this manual include things related to operations and accounting transactions like hiring new employees, how to solicit donors, how to pay invoices, how to process payroll. If you have inventory, how inventory is taken, and how to prepare journal entries. They're all examples of what could be included in a policy and procedures manual. So if you don't have one, you want to create one. And if you have one, it needs to be updated. It's, again, with all these documents, it's not about making a document and then having it sit on a shelf. It should be a living document that is constantly referred to and updated. I mentioned accounting processes as part of this manual. In particular, you want to look at, when you're documenting accounting processes, the procedures that are done to initiate, authorize, and record transactions, as well as reporting, how to pull together financial statements for board of director meetings, how to prepare month-end financial statements, year-end financial statements. And these policies should be focused on things such as making any calculations that are involved, or capturing and sorting data, how to update transactions, how to summarize and report data. There's a lot of things that go into a policy and procedure manual. It can take many shapes as well. I've seen manuals that are done in flowchart format. I've seen that are written in a narrative format. All of them should have reference to example documents and forms that are used on a routine basis. And ultimately, this can be stored either as an electronic document or as a hard copy that can be referred to. I use the term walkthroughs as a good way to start putting together a policy and procedure manual. Think about some of your most significant transactions, whether it's soliciting contributions from a donor, or you have a mail campaign that you are receiving contributions through mail. How do you get through that process and walk through it? Take notes as you walk through that process from start to finish, and that's ultimately going to be used to develop your policy and procedure manual. The final document that I want to talk about is it's called the Document Retention and Destruction Policy Document. We talked about these previous four. Now we need to talk about how to either retain or get rid of them in certain circumstances. Any organization should have a document that complies with applicable federal and state laws regarding retention, and making sure that you keep things for a certain specified period of time. One area for nonprofits that I've seen this come into play recently is within grant agreements. Some of those grant agreements that you receive from either a foundation or state agency might have very specific retention requirements regarding any type of data, whether it's people that are being served by the money that you've received or reporting data. You want to make sure that you're following these grant agreements and making sure that you adhere to those retention policies. Paper versus electronic retention. This is a question that I get a lot, is how you should refer to something and keep it for whatever that period of retention is. And in our opinion, requirements for keeping things electronically are exactly the same as paper records. So if you want to keep things electronically, that's what I would certainly recommend. We do that internally with our audit process. And just keep in mind that there's also electronic communications that might fall into a retention policy as well, whether it's emails, general files, PDF files regarding like bank statements that are kept electronically. All that kind of falls underneath that system. Another question I get a lot of times is how long should something be kept? And there's rules out there regarding this. And again, I would just want to make sure that it's clear that you need to follow applicable state and federal laws. But kind of my rule that I use is, would the document be cited as a resource in your organization's autobiography? If it is, keep it permanently. So things like audit reports, board minutes, financial statements, bylaws, licenses, those are the things that could be cited in your organization's autobiography. You want to keep those forever. Everything else, keep for a minimum of 7 years past the document's end date. So if you have a contract that ends on a certain date, take it that date plus 7 years. That's kind of my general rule of thumb. Again, I'm not a lawyer, so I can't hold to that being held up in a court of law, but that's kind of my rule. If it's something that's of very importance to you, keep it forever. Other than that, 7 years. if you do visit our website and our news blog, we do have an article regarding document retention and destruction and some more specific guidelines that I encourage you to visit. And that website is at the end of the presentation for you to look at. All right, the last part of my presentation is focused on 10 hot topics in the nonprofit world. I've attended a couple conferences of late, and these are some of the things that are being presented as matters of importance to the nonprofit community and things that I just want to make sure that this audience is aware of as well. So the first hot topic I want to mention is executive compensation, and this gets a lot of buzz in the press regarding the compensation that nonprofit leaders are receiving, and it gets a lot of attention. Like I said, the board of a nonprofit organization should provide for what's called reasonable but not excessive compensation, and there's rules to follow to do that and best practices to do that. I think first and foremost is that compensation should be tied to performance. There should be predetermined goals that are made by the board of directors and then are used to evaluate executive compensation. The IRS has a 3-step policy for setting compensation, and if you follow this, and you follow this 3-step process and you answer the question in your head, does the compensation appear to be justifiable in view of the organization's activities and responsibilities? I think you're on the right track to making sure that your executive compensation is adequate. The 3-step process for setting compensation is that there needs to be a review of compensation by an independent body, whether that's a compensation committee, an executive committee of the board of directors, or some type of outside consultant, if you will. It needs to be reviewed by an independent body. The second part of the 3-step process is that there has to be some type of comparability data used. You cannot just determine executive compensation out of thin air. It needs to be thought of what other organizations are out there that are similar to ours that we can compare to. Perhaps you're part of a network or affiliation. You can get comparable data to look at. And finally, the IRS requires this process to be documented, so there needs to be documentation of the consideration of executive compensation. And lastly, executive compensation not only includes salary, but you need to think about things such as insurance, auto allowances, housing allowances, and other fringe benefits that your key executives might be receiving. The next hot topic is expense reimbursements, and expense reimbursements are an opportunity for fraud to occur, and I think that's why it's gotten a lot of discussion as of late. Documentation is required for expense reimbursements for all of your employees. Required that documentation be kept. The best practice that is used is any type of expense reimbursement greater than $25 should have a receipt attached to it. And at a minimum, the documentation that is kept should have the date and time of the expense amount, the persons that were receiving benefit, whether if it's for entertainment or travel, and then ultimately the business purpose of the expense. That those are the questions that should be able to be answered regarding any type of expense reimbursement. Make sure that you have an adequate review and approval process put in for expense reimbursements. So they're not just entered and approved. There needs to go through a good review process. One area that I get questions about in my practice is, what about the executive director? They're the ones who are traveling and spending money and going out to dinner. Who's reviewing those transactions? Well, it depends is the answer, depending on the size of the organization. If it's a larger nonprofit organization that has another number of other C-level executives, there could be somebody else that's reviewing it. Perhaps the board of directors is reviewing the expense reimbursements for the executive director for a smaller nonprofit organizations. That's something else that I've recommended in the past. Some things from a fraud perspective, if that would be an indicator for just being able to ask some additional questions and be alert to the existence of fraud potential, is any type of unusual or unexpected patterns, fluctuations in expense reimbursements. And ultimately, you want to compare dates of expense reimbursements to work assignments. So if you're getting expense reimbursements for approval that don't match up with an employee's job responsibilities, that's a key indicator that something's going on there that shouldn't be. And one final recommendation that I've made in the past is the use of a corporate card for business travel that helps distinguish the personal versus business reasons for certain items, and helps hold the employee or the key executive accountable for what they're ultimately submitting for reimbursement. The third hot topic is the IRS Form 990, and I'm just going to be very brief here, but I want to just make sure that everybody knows how critical of a document this is. It's a public document. It's out there. You can fire up Google right now and Google your own organization's 990, and in a matter of seconds, it's going to be there. It was redesigned a number of years ago, and that purpose was to increase the transparency regarding an organization, whether it's the mission, governance, financial results, and the IRS continues to make a couple changes to this every year, though there's not a sweeping change to the 990, but it is constantly being evaluated and tweaked. Part 3 of the form requires you to talk about your program accomplishments. This is your opportunity to really kind of be the advocate for your own organization and really talk about what you've accomplished and those programs that you've instituted and conducted and what those results are. So I just encourage you to not be afraid to brag a little bit on your 990 and talk not only about your mission but your program accomplishments. Finally, board review and approval of the 990 is also, again, required. It's a question on the actual document. It's something that your board should be reviewing. They should be asking questions about, and it should be made part of the agenda of a board meeting on an annual basis, that there's time spent to review and approve the 990. Finally, I just want to make one other comment regarding the availability of the document. Nonprofits are required to make this available for public inspection. And you'll note that in Part 6, Section C is where you disclose how you're doing this. You have an option of providing it upon request on your own website or another's website. GuideStar is not another's website unless you provide that document to GuideStar directly. So if you're checking that box, another's website, and it refers to GuideStar, GuideStar having a copy of your organization's 990, you can really only check that box if you're providing that document directly to GuideStar. GuideStar gets the majority of its documents from the IRS and other means, so just knowing that your 990 will ultimately appear there is not actually making it available for public inspection. So I'd recommend checking the upon request box there. Restricted contributions are getting a lot of attention right now. And that's because I think donors are becoming more and more, I don't want to say stingent with their money, but they want to make sure that their money is being spent for the purpose that they're donating it for. So a lot more donations are having restrictions attached to them, is what I've been seeing. Nonprofits, as I think the majority of us know, require that contributions and ultimately net assets are reported in 3 categories: unrestricted, temporarily restricted, and permanently restricted. And that the donor restrictions that are attached to a contribution ultimately drive the accounting treatment. And those restrictions can be based on time or purpose. You must hold on to this money for 10 years, and then after 10 years, you can do with it whatever you want. Or I'm going to give you this money, but it has to be used to build a new playground at the daycare center at your organization. Donors want to make sure that their money is being used appropriately, and more times I'm seeing restrictions attached. And the failure to follow any restrictions can result in penalty. It can result in recapture of amounts that were received, and that's not something that any organization wants to go through. So as you receive contributions, it's just be very, very attentive to any type of restrictions that are included. So likewise, when you receive contributions, you need to be careful about any restrictions. But when you also disperse money to people, you need to be careful that you're giving the money to the right people that need to be receiving it. So there needs to be procedures set in place to select the correct recipients of funds. And this is really, again, another hot topic that I've seen, is that organizations have gotten into trouble when they've dispersed money to individuals or organizations who did not do not really justify the receipt of those funds to begin with. So there needs to be procedures completed up front regarding the authenticity of a recipient. So if you're giving money to another nonprofit organization, verify the exempt status. And it's not just about federal funds, and there's a big reputational risk for giving money to the wrong people. Again, it's the stuff that the press loves to get their hands on. Read fine print and grant agreements. So make sure that that you're giving money to certain eligible people regarding the money that you've received and it's being passed on appropriately. And make sure that you have controls in place regarding monitoring of that. If you're giving somebody a large check, I think it's okay to ask down the road a little bit how they use that money, if it's being used for the purposes that were set, and make sure that that follow-up visits are occurred as necessary. And finally, I just want to quickly touch on internal controls regarding vendor payments. This is another fraud risk. So I've talked about recipients of funds mostly from a program standpoint, but also consider things regarding vendors as well, and look for having strong internal controls regarding vendor payments. Anytime you see a new vendor pop up on a check run, if you're reviewing the check run, it's things to ask about to make sure that those recipients are actual real organizations and should be receiving your nonprofit funds. One area that's getting a lot of attention recently is the functional expense allocation of nonprofit organizations, and this has really been the case for a number of years. And we're seeing this because there's been errors done in the calculation of functional expenses and how organizations allocate certain expenses that are between multiple categories. Those categories, I think nonprofits can recite those in their head. Management in general, program and fundraising are the three required categories for functional expense reporting. Some of the common errors that we see in this is reporting all expenses as program expenses. I think a lot of times organizations like to think that everything that they spend on is related to their program. Well, that's just not the case. There's a management component to it. There's a fundraising component to it as well. No allocation of personnel cost amongst categories. So that's another common error that we see. Another error that we often see is not allocating things like insurance, occupancy, depreciation expense. All that has a component not only of program management in general and also fundraising. Waiting to the end of the year to discuss and determine allocations is also an error. As you're incurring certain expenses, you should be thinking about how it's going to impact your functional expense allocation and having those discussions and decisions made and documented at that point in time. Ultimately, another error that we see a lot of times is the use of a fixed percentage to allocate cost rather than a rational basis. So as you go through your allocation process, just because it was 7% fundraising in the prior year doesn't mean it has to be the same thing in the current year. It needs to be done on a rational basis, on a continually being updated basis. Mobility is another hot topic for nonprofit organizations. I think most of the times nonprofits are a little bit behind the times when it comes to electronics and mobility, but really there's been a push for nonprofits to go mobile. I think of going mobile for a small nonprofit organization as being able to accept a donation or payment anywhere that they are. Smartphones have the ability to accept donations and do that. Consider having that as an option at your next fundraising event if you don't currently do that. With mobility, there also is expense, and there's a pretty significant capital expenditure outlay for that. So having the dollars to do so can ultimately be difficult for a nonprofit organization. So as you're wanting to go mobile and have your caseworkers and your employees out there with iPads and MacBooks, it's great to do that, but make sure you have the funds available to do that. A lot of times foundations have money set aside for these type of capital expenditures that you can get to help better your organization. And ultimately, it comes down to a cost-benefit analysis, whether or not this makes sense for your organization, and consider that as you're going through discussions regarding things like social media, website design, online stores, PayPal, etc. Overall, board of directors is another hot topic that gets a lot of play right now in the press and people who I've talked to. A couple key things that I want just the audience to think about when talking about board of directors is what's the optimal size for your organization. Are you a new organization that started 3 years ago and had a board of 3, but now is considering multi-state operations and has really expanded, and you need to increase that role and increase the number of board of directors? That's something to think about. And conversely, do you have too many board of directors that doesn't allow you to get things done at meetings? Think about those boards that have 15, 20, 25 people on it, and those meetings just don't get a lot of things done at, and consider that as you're looking at the overall board of director composition. You want to make sure you have the right people on your board, certain expertise and certain requirements. I meet with a lot of board of directors in my business and my work, and I always encourage boards to be open and frank in their discussions. A lot of times there's a lot of rubber stamping that goes on in board of director meetings, and that really defeats the purpose of what a board is supposed to be there for, to govern an organization, to set policy and procedure. Doing things like retreats, having a report card to see how well you are operating as a board are all best practices, and use committees to get things done. So if you do have a large board, have separate committees that are working behind the scenes to get things done, and the board is there just to ultimately look at strategy and risk of an organization. That's a real focus, I think, that we're seeing, is that we're getting away from a lot of working boards and operational boards to more board of directors who are focused on overall organization strategy and risk. I just talked about the board of directors and having committees, and one of those committees that is of essential importance is the Audit Committee. An Audit Committee is there to interact with the independent auditors. It's there to answer and work with executive management regarding accounting treatment and risk. It can be that organization that responds to conflict of interest. I've seen that be the case as well. But always, an audit committee should be independent of the organization. There should not be any type of conflict of interest between the audit committee and the organization. It doesn't always have to be a subset of the board of directors. I've seen this be a benefit to organizations as a way to bring in that financial expertise onto an audit committee. There's CPAs out there who like to serve on audit committees who don't like to serve on boards, and having that expertise on an audit committee is exactly what you need to do. Audit committees should have a written charter regarding their responsibilities and roles, and they really need to be meeting and communicating with the external auditors on a regular basis. I encourage the organizations that I work with to meet with the audit committee not only at the end of an audit engagement, but also during the planning stages, so they understand what we're going through regarding our risk assessment and our audit planning, and also for us to have an opportunity to hear what's of importance to the audit committee themselves and help set some direction to the overall audit. Fraud risk assessment is one last hot topic that I want to talk about, and it's something that is prevalent not only in for-profit organizations, but nonprofits are not immune to fraud, and they really need to be considering fraud risk as part of their overall organization strategy. You know, I talked to a lot of people in this area, not only in nonprofits but also fraud, and a lot of people believe that small organizations like nonprofits are actually more susceptible to fraud because they have smaller staff, they have less people who are working there. They have the belief that the mission of an organization is above all else and that nobody would steal from a nonprofit organization. Well, that's just not the case, and fraud does occur at nonprofits, and it occurs regularly. Organizations need to have a fraud risk assessment in place to help prevent fraud from occurring. Essentially, what a fraud risk assessment is looking at what could go wrong in an organization and making sure that the organization has a response to what could go wrong. What individuals in the company might have the opportunity to misappropriate assets? Who could steal money? Are there known pressures from employees that might entice them to do something wrong? Are there certain areas of company transactions that, just because of how they're organized, are more susceptible to fraud? Are there a lot of people in the field with money that could be stolen? Those are things to be thinking about as you go through a fraud risk assessment. A fraud risk assessment can be performed by senior management, it can be performed by an outside consultant, it can be performed by the board of directors. And the goal, like I mentioned, is ultimately determine where risk exists and what you have in place to prevent that from occurring. There's always going to be risk, but you want to be able to mitigate that to a level that's appropriate and acceptable for your organization. That's ultimately what a fraud risk assessment is. Well, that concludes my presentation on a couple of the new accounting standards that were issued and some governance hot topics and a couple things of importance in the nonprofit community. I'm going to hand this presentation back over to Reed for a couple closing comments, and then I'll be here to answer questions that the audience might have. Thank you, Reed. And looking at my clock, I see it's 3:03, so I will try to answer these questions that have come in as quickly as possible. I've got a couple that come in, and the first one, I'm going to read it to the audience here. All of the governance and best practice ideas sound good, but, and but's all capitalized, how does an organization with limited resources go about implementing them? That's a good question because, I think I mentioned it a couple minutes ago that nonprofits are often faced with limited resources. And because of that, I think implementing best practices, whether it's accounting or governance topics, can be of a challenge just to get people on board. I think my advice to that question is don't feel like you have to do it all. I gave a list of about 15 things that you could be doing, but don't feel like you have to do them all and don't have to do them all right away. Take one or two initiatives and try to do that on an annual basis, and over a period of time, you'll get yourself in a better governance position. Get the board of directors involved. I get asked that question a lot. How can I get my board more involved? Well, I think boards are often looking for things to grab a hold of and take ownership of. And if you can get the board involved in some of these governance topics, it can better the organization as a whole. And also, I think, finally, think about what's most important to your organization. Some of those topics that I mentioned, like mobility, might not be of benefit to a growing organization who's just out of the box, but some of the other things I talked about could be of more relevance. So hopefully that provides a little answer to that question. And looking here, the second question from Patrick reads, I was an attendee at your last seminar, it must be the nonprofit seminar back in June of last year, and you mentioned lease accounting changes. Any update to the lease accounting changes? Yes, there have been a lot of changes to lease accounting, and in fact, I probably could have included 15 to 20 minutes just on lease accounting itself. And in short, there was a second exposure draft that was issued back in May on proposed lease accounting changes. The comment period is currently open for that. There were some tweaks to the original lease accounting guidance that was exposed about a year prior to that. Essentially, it follows, I think what's called a right of use model, and puts leases into categories of a type A and type B lease. And then you look at whether or not I think the lessee consumes more than an insignificant portion of the lease asset. So yes, there is some guidance changes out there, and as that becomes more finalized for the not-for-profit community, but also the accounting community as a whole, you'll see some more information from McKonly Asbury on that. So good question, Patrick. Let me take a look here if there's any other questions. I don't see any other ones that have come in. Again, thank you for your time. My contact information is on the slide that you're seeing right now. Feel free to reach out to me at any time with questions regarding this presentation or anything in general. Hope you have a great afternoon.
Thank you once again for joining us for this presentation produced by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thanks again and have a great day.